Hi, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, November 1st, 2025. Happy New November. Hey, I hope you're doing well. I hope you had a good trading week. I hope you had a good week in general, and I appreciate you coming to my weekend review podcast. I hope this is going to be helpful for you. The format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades I made last week. We're going to look at the new entries I made. We're going to look at the exits of trades that I make. We're going to look at the current positions that I have. And we're going to talk about it all. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the confluence of entry signals were. We're going to talk about how I position size correctly based upon the volatility of the market and my account. We're going to talk about where I place my end of bar stops, where I place my emergency stops, how I take partial profits if it starts to move my way, how I tighten up my stop if we get to trailing stop level, and then also ultimately how I exit all the positions, whether they're my stops or my ultimate profit targets. So I do have a lot of positions that I am in and actually got out of today. So I kind of this week I paired some of my positions down. But if you like seeing why there's a trade setup, how I enter, how I manage it, how I exit, I think this will be a good podcast for you because I have a lot of examples. After we take a look at all the trades that I made, we're going to talk a little bit about trader psychology. I say this every week, everybody, but it's true. The most important skill in trading is the ability to get yourself a good trading process, but more importantly, then following it. I know I talk about this every week, but it's so true, everybody. Trading is not a big mystery. There's not a secret to it. Uh, well, maybe there is. The secret is get yourself a decent trading process and follow it like a laser beam, right? Just follow it. But the problem is a lot of people have an issue with that, and that comes down to trading psychology. So I always like to talk about trader psychology. It's always helpful for me to teach, and I hope it's helpful for you to hear little by little, right? Then after that, I have gone down through my watch list. I go down through my watch list every Friday night, one by one. And when I go through the watch list, I look for potential trades for next week. I look for something that's kind of getting close within striking distance of a proper setup for me. And a proper setup for the way that I trade would be is it near a bullish order block if I'm trying to go long? Is there a major moving average or a certain RSI level that lives inside of that order block? Um, do we have higher low V1s, V2s going on? Are there bullish divergences, right? So this is what I look for. And I like to do it on Friday nights because I go through a list of about 80 and then I narrow it down to, I think for this podcast, I have 11. So these 11 are not ready to go yet, but they're getting kind of close within striking distance. And they have all the things that I just mentioned, order blocks, divergences, RSI levels. And so if next week one of those does get to where I want it to do and does what I want it to do, then I will consider taking the trade. So hopefully this will be helpful for you as well to just kind of give you an idea of what I'm looking for, the confluences, and then if those happen, how I'm going to get in the trade and go forward with the trade. So if you do find anything of value in the podcast today, I really would appreciate it if you could just take a second and hit the thumbs up button. It really helps with the channel, lets YouTube know that there's some valuable content so they can get it out. And if you haven't subscribed, that would be great as well if you could do that as well. So before we kick it off, let's start with the U.S. legal disclaimer, get that out of the way quickly, and I'll be right back. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, well, let's get started with my current open positions, and I've zoomed out here a little bit. I'll zoom in so you can see it a little better, but this is Walt Disney. I entered Walt Disney on the 16th of October, so I've been in this trade for a couple weeks. So I entered the trade at 109.86 right here, but I entered the trade for two reasons. We have an order block, which is this green box, and we also have the 200-day moving averages is the black line in the middle. So let me first talk about an order block, and I have to go back here a ways to do it. So an order block, and if you don't know about order blocks, they're going to transform your trading. Really, they're such a good place to look to enter a trade, because if you're wrong, you can be wrong fairly small. And if you're right, you can have a big trade. And that's ultimately what we're looking for in a trade. But we have an order block that started back here on 523.25. So what's an order block? An order block, in order for an order block to form, you need the following. You need a swing low, which happened here on the 16th. A swing low is simply a low that has a higher low to the left and a low that has the higher low to the right. So you can see to the left, that low is higher than in the middle, and to the right, it's higher than in the middle. So you first need a swing low followed by a swing high. Swing high is opposite. You have a high with a lower high to the left and a lower high to the right, right? So we have a swing low, we have a swing high. Then you need in the future, you need another swing low that is lower than the first swing low. So swing low, swing high, lower swing low. Now, once you have that in place, in the future, if you go above that first swing high, now you've changed market structure to the upside. And that happened here, right? Swing low, swing high, lower swing low, and then here we got above that first swing high. As soon as that happens, now you've changed market structure to the upside and you have defined your order block. An order block is simply the lowest closing bar before market structure. And you take the high and the low, and that is your order block. And so I have the high and the low, and I bring it all the way into the future. And if you come back to that order block, well, that's the place that I'm looking to enter. So take a look here on 630. We're way high up here on Disney. Well, if you look back in the past, because when you're up here, you know this order block formed, the order block formed here. But when you get way up here, you can look back and go, in hindsight, was smart money buying in this area? Yeah, it certainly was, clearly, right? In hindsight, you can see that clearly. If you're up here and you go back here to this order block, you can say that, okay, clearly there was some smart money buying there because that was the bottom and it went straight up. So the idea with the order block is that when you look back at the smart money area and you bring that into the future, it was smart money here. Is it going to be smart money if it gets back to that same area in the future? And the answer is maybe. Not always. Things can change, right? News can change, geopolitics can change, but more times than not, it is smart money again, and we'll rally from there. Of course, we need to position size, we need to have our stops if we're wrong, and so forth. So, but that's the order block. Swing low, swing high, lower swing low, market structure change, defines the order block, bring the order block or the smart money area into the future. Okay, so let's zoom in here now. So now you understand what this green box is. So green box, order block. Now, I also teach a deep dip buy strategy. deep dip buy has to do with the 200-day moving average, it has to do with the 250-day moving average, has to do with the 300-day moving average, and the 30 RSI as well. My favorite trade in the world is when you have an order block and then you have a major moving average that lives inside that order block, like this 200-day moving average. Now, keep in mind, a rejection of a 200-day moving average by itself is a legitimate entry. A rejection of a order block by itself is a legitimate entry. But the two of them happening together is much stronger. So here, now it kind of gives you an idea of why I took the trade. So I entered the trade here on the 16th of October at 109.86. Why? Because I had to be patient, and I came all the way back into the smart money area. Not only did it come into the smart money area, but it also rejected the 200-day moving average. So again, I got in 109.86. Now, as soon as I enter the trade, really the most important part, in my opinion, of getting into a trade is how many shares do you buy? Well, that has to do with, for me anyway, two things. How much do I have in my trading account? And what is the value of the 2 ATR? The 2 ATR just means 2 times the average true range. And so just by default, this measures the average range of the last 20 days and doubles it. And so when that happens, basically what the ATR is telling you is how much volatility. If there's a lot of volatility, the bars are going to be larger. This number is going to be higher. If it's low volatility, the number is going to be lower. And so I'll show you in a minute why that's important. So just keep in mind that the 2 ATR is measuring volatility. So I always say you need to position size based upon volatility, and the way that I do that is by using this number. So the first thing for me, how much do I have in my trading account? Okay, let's just say I have $100,000 in my trading account. I take 1% of that $100,000, which is 1,000, and I simply divide it by the volatility, right? This is essentially what I'm doing. I'm dividing it by the volatility. If I have 200,000, 1% is 2,000. If I have a million, it's 10,000, and so forth. So two things. How much do I have in my trading account? $100,000, say, 1% of that, $1,000. I divide it by the value of the 2 ATR, divided by 4.21. Tells me exactly how many shares to buy, 235.52. I can't buy a fraction of a share, so I'll just round that up to 238. Okay, now I know how many shares to buy based upon my account value and the value of the 2 ATR, 238 shares. Now, the first thing I do after I have the entry, right, rejection of the 200-day moving average in the order block, I just position sized, I'm buying 238 shares. First thing I do, I take my entry price minus the value of the 2 ATR, right? We just used that number. And I go down here, right? My entry price minus the 2 ATR. This is now my emergency stop. This is my kind of my worst case scenario. If I have 238 shares and it moves down to 4.21, I have lost $1,000. I have lost 1% of my account. Well, that's going to be my maximum allowed loss, right? I mean, when you get into a trade, you have to have a point where you're like, okay, I give up, that's enough. Well, for me, it's 1%. It's black and white, right? Now, the good news is that this emergency stop does hit. Certainly it hits, but it only hits about 5% of the time. The other 95% of the time, if I have a loss, it's not going to be because of my emergency stop. It's going to be because of my end of bar stop. And I entered with a rejection of the 200-day moving average in the order block. So my end of bar stop is simply if it closes under the 200. If the next day it had closed under the 200, even a penny, 2 pennies, 5 pennies, I would have gotten out. I'm done with the trade. but I had a very, very small loss. So we have the emergency stop down here for the worst case scenario. And end of bar stop is simply a close below the 200. Now, depending on what strategy I use, I have different end of day stops. I always have the emergency stop regardless, but depending on strategy, sometimes it's a different end of bar stop. But on this one, because I took the trade, because it rejected the 200, therefore, if it closes below the 200, I'll simply get out. And that's the key, getting yourself in a trade that allows you to have a large upside potential. But if you're wrong, being wrong very small. That's why I like to take the trades that I get in as close to my end of day stop as possible. Okay, so next thing, when I enter the trade, I look for the 1.5 ATR value. Right now it's 316. So I enter the trade. I place my emergency stop 2 ATRs below my entry, but then I add the value of the 1.5 above my entry. This is my trailing stop level. All this means that is when I take the trade, if in the future it starts to go my way and it gets up to my 1.5 ATR trailing stop level, the orange line, doesn't mean I take any action. It just means that once I get there, now it's moved enough for me to start tightening things up, right? If you get into a trade and it starts moving your way, you want to start getting kind of doing a trailing stop and tightening up your stops. Well, by going to trailing stop level, it does that for me, because what does trailing stop mean? It just means that once I get to trailing stop level, now in the future, if I have a close below a previous bar's low, I will exit half of the remaining shares that I have. And by doing this, this is a way to tighten everything up, move everything up, because you're reducing everything by half because you're selling half. Okay? So everything I've talked about so far as the emergency stops, the end of day stops or the end of bar stops, and then going into trailing stop level, if it starts moving my way, these are all defensive moves. It means that if the market goes against me in a certain way, emergency stop closes below my end of bar stop, you have a close below previous bar's low after reaching trailing stop level. These are all defensive moves if something's going against me in the trade. Well, that's defensive. But as I always say, I like to play offense in my trading as well. And the way that I play offense in my trading is very simple. If the price moves a certain distance from the previous day's close, I will take a partial profit. I will be selling into strength. I want to take some profits partial if the market's going my way. And this is very simple as well. Let me just show you. So I'm in Disney right now. All I do to do this, and I do this every single day, I place 3 limit orders every single day, and it all starts with the closing price of the day. So Friday we closed at 112.61. All I do is I take 112.61 and I add to it the value of the 0.45 ATR. Right now, the 0.45 ATR is 95 cents. So I take the closing price, 112.61 plus 95 cents. My first profit target for Monday is 113.56. And if it gets there, how much do I take off? However many shares I went into the day, 10%. If Friday I had 100 shares, Monday, 100 shares, 10% of 100 is 10. I would take 10 shares off at 113.56. If I had 500, I take 50, right? And I place 3 limit orders, partial profit orders every single day. Closing price, 112.61 plus the value of the 0.45, it's 95 cents, 113.56. That's my first profit target. Then I take my first profit target, 113.56, I add it again. Simple. My second profit target for Monday, 114.51. And then I do it one more time. 114.51 plus 95 cents, 115.46. So there I have my 3 profit targets sitting in the system. If the market's down on Monday, maybe I don't hit any profit targets. If it's up, a bit. Okay, I hit one. They add up over time, trust me. And one of the other advantages is you're selling into strength. You're reducing your position size a little. The, the more that your position size becomes less and less, the less heat, emotional heat you have on the trade, and the better you follow your process. So there's a lot of different advantages to doing this. All right. Okay. So now that I've kind of explained the basics of everything, let's go through the trade. All right. So I entered the trade on the 16th of October. Why? Two reasons. We got into the order block and we intraday rejected the 200-day moving average. I got in at 109.86. I position sized correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. I placed my 1.5 ATR trailing stop level 1.5 ATRs above, and off we go. The next day, it moves up. Great. I hit a profit target. Perfect. Next day, moves up again. Hit another profit target. Next day, up biggies. I hit multiple profit targets on this day, and also on this day, I got to trailing stop level. Does not mean that I have to take any action. It just means now in the future, I am in trailing stop mode. Next day, down, no profit targets. Next day, no profit targets, but we did not close below the previous day's low. I did not have to take any action. The next day, no profit targets, and look what happened. We have a close below a previous bar's low after reaching trailing stop level. What do? I sell half of the remaining shares that I have, and that's exactly what I did for a gain of 1.67%. Then we just kept going down. No profit targets, no profit targets, no profit targets. Am I still in the trade? Yes, I am, because we did not close below the 200-day moving average. The next day, we poked our head underneath the 200, but remember, I don't take action until the close, and then it reversed back up, where I hit multiple profit targets again, thankfully. Ended up closing above the 200, kept me in the trade. And then Friday was up again. Okay, so the remaining shares that I have on this particular position, the remaining shares up 2.48%. Looks like we have earnings out here on the 13th of November. I never hold through earnings. So regardless if I'm still in this trade, by that time, I will exit position. But there you go. Remaining shares on Disney up 2.48%. Okay, here we go. Pfizer. Well, Pfizer is similar to Disney, where we have, excuse me, the confluence of an order block. Again, why an order block? Swing low, swing high, lower swing low, market structure change. That defines the order block here, lowest bar close, the high and the low in that. We bring that into the future. Okay, we're into the future now. And I entered here on the 17th of October at 24.51. Why? It rejected the high of the order block. It rejected the 200-day moving average. I entered. I placed my emergency stop 2 ATRs below as always. My end of bar stop is simply a close below the 200-day moving average. I placed my 1.5 ATR trailing stop level above, and away we go. So this one, it just tried to move itself up. I think I did hit one profit target here, and then we've kind of moved sideways and gone nowhere. Thursday, and then we came down. Thursday, you can see we again went under the 200-day moving average, closed above. That kept me in the trade. Had this closed below the 200, I would be out. And then on Friday, we were up, and I did hit 2 profit targets. So there is earnings coming here on the 4th of November. I will have to exit this trade before that happens. Not in trailing stop level, really hasn't moved very far or done anything. Up on the trade, 0.65%. So, hey, I'm grateful for that. But, you know, a lot of consolidation, a lot of sideways motion. Eventually, this is going to move. Sideways motion always leads to trends. Trends always lead back to sideways motion. But that will probably happen after earnings, which unfortunately I won't be in the trade. But nonetheless, remaining shares up 0.65%. Costco. All right, so Costco is a relatively new trade. I've had some good trades on Costco and exited them, but now have a new trade again. So we have an order block here. Wait, why did my charts move? Oh, there we go. Now, sometimes my charts move. I don't know why. Okay, so we have an order block here. We changed market structure here. We came all the way back down. Now, a lot of times with the order blocks, I'm looking for the 200-day moving average, 250, 300, 30 RSI, but sometimes you don't have one of those in the order block. So I have to make my own if it's a legitimate reason to do so. So I placed my line in the sand here. I just moved this a little bit. 10, 108, 908.80. So I picked this line, I kind of made my own. Why? How did I justify making this here? Well, going back here to the 7th of October, we have a nice big up bar. Whenever you have a nice big up bar, if in the future it comes down to about halfway of that big up bar, there's some inherent support there. All right. And so that is why I picked this level. Again, one, we're in an order block. Two, this is my level inside the order block, the halfway mark of the big up bar. So we went up, great, but now we have come back down. Just imagine this green line, the halfway of the big up bar, just imagine that like a moving average. I took the entry here on the 29th because we rejected the green line here in the order block. What do I mean by rejected? Well, during the day we touched it or we went under it. We went under it in this point and then closed above. That is a rejection of that level. So I entered the trade about 911, excuse me. I position size correctly. I placed my 2 ATR emergency stop below, and my end of bar stop is very, very close, like it should be here at the 908.80. Friday, had this closed below that mark, I would have been out of the trade for a very, very small loss, but it did not. It held above, so I kept in the trade. So rejection of that midpoint, the 908.80, position size, emergency stop, end of bar stops closed below that line of 908.80. I placed my 1.5 ATR trailing stop level above. The next day it moved up. I did hit a profit target. It was down on Friday and 9/11, and it's 9/11.45. So, essentially up a little, but basically your break even trade so far. But this is a good example of waiting and having patience for it to come back into an order block, reject a certain level, and then have a very good risk to reward ratio so that if I'm wrong and it just closes 1 penny, 5 pennies, 20 cents, 30 cents below a dollar, doesn't matter. Then it's just a small loss. And then of course, overriding, I also always have my emergency stop 2 ATRs below. But again, that doesn't often hit, only about 5% of the time. So essentially, Costco here is about a break-even trade. Okay, USO. Well, USO again, order block. This order block, so I entered here on 10/20. Let's take a look at the order block. The order block goes way back. All the way back here is 530.25. Swing low, swing high, lower swing low. Market structure change. This defines the smart money area or the order block, the lowest bar close. I bring this all the way into the future. And look, 1, 2, 3, 4, 5. You have to wait 5 months for this to set up and come back. Well, it did. And here we go. I entered here on the 20th at 67.81. Why? a rejection of the order block, of the high of the order block. Now, I didn't have a 200-day moving average or anything inside it. And, I was teaching this last week, but if you have a very wide order block, then I really need to look for something in the middle, midpoint of a bar, 200, moving average, 30 RSI. But this is a fairly short order block. It's kind of a teeny weeny order block, meaning it's not very far from the top to the bottom. So in this particular case, I was like, okay, I'm fine to take this trade. My end of bar stop, just simply a close below the low of the order block. Okay. So rejection of the high of the order block, I position size, I placed my emergency stop 2 ATRs below my end of bar stop again, just a close below the order block. That's the second green line here, the low. I placed my 1.5 ATR trailing stop level above, and off we go. Next day, takes right off, hit multiple profit targets. Next day, up again, multiple profit targets. And in addition to that, got to trailing stop level as well. Doesn't mean I do anything. It just means I'm in trailing stop mode. The next day, up again, biggies, multiple profit targets. So you can see as it moves straight up after I bought it, I'm selling, 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 selling into that strength. Now, here on the 28th was our first close below a previous bar's low. What do? I take off half the remaining shares that I have. And that is what I did. And so half of the remaining shares got sold for a gain of 4.97%. But I still have half going on. And you can see the next day it went up, took some profit targets. Next day, no profit targets. And then on Friday, up again, profit targets. So the remaining shares that I have on USO are up 6.45%. So really nice trade, just using the top of the rejection of the order block. Okay, so those are the open positions that I have. Real quick recap: Disney remaining shares up 2.48%, Pfizer remaining shares up 0.65%, Costco basically essentially break even, and USO up 6.45%. So now let's go to the daily positions that I closed out this week. NVDA. All right, well, this was a monster trade. I entered NVIDIA here on the 15th of October at 179.92. Why? Well, we have an order block, right? We have an order block. We have a swing low. We have a swing high. We have a lower swing low. We have a market structure change that defines the high and the low, the lowest closing bar moving forward as the order block. I entered here on the 15th. Why? Well, you see the gray line? This gray line, it's not the 200, 250, or 300. It's the 50, but it doesn't matter. I'm just looking for a line in the sand to key my trade off of from a risk to reward standpoint. So on the day that I entered, and I entered 179.92, we came in the order block. We went below the 50. We closed over the 50. So I entered position size, placed my emergency stop, 2 ATRs below as always. My end of bar stop is simply a close below this 50-day moving average. See how close I am to it anyway, to kind of get the idea, right? If you can be as close to your stop as possible, you can lose the least amount of money as possible if you're correct. Okay, so then I placed my 1.5 ATR trailing stop level above. Next day, up a little, profit target, up a little, down. Here on the 22nd, I was almost out of the trade because during the day we were much lower than the 50. Remember, any close below the 50 gets me out of the trade. However, by the end of the day, it closed above, and that kept me in the trade. Next day, up, profit target. Next day, up, profit target. Next day, up, profit target. Also in trailing stop level. Next day, up, biggie bigs, where I hit multiple profit targets. Now, on this particular day, at the end of the day, I sold half of my remaining shares. Why? Because during the day, we went to, you have to look over here for the RSI levels. During the day, we went above 70 and then closed below 70. It rejected the 70 RSI. That for me is a reason for me to take off half of the remaining shares that I have if you reject the 70. If this would have closed above the 70, I would not have taken any action. But the majority of time, if you get to the 70 RSI and then close below it during the day, that's a short-term top. So we went above 70 during the day, closed back below 70. I took off half of the remaining shares. Okay. Next day, up huge again. I did take off half the previous day, but at least I kept half, right? That's the key. Next day up, multiple profit targets. And then on the 30th, I exited the entire trade. Why? Because it closed below the previous bar's low. So this is what happens at the top. If I reject a 70 RSI, I get out of half of the shares. If then, after rejecting the 70 RSI in the future, if I have a close below previous bar's low, like I did here, after rejecting the 70 RSI, that's it for me on the trade. So I exited the trade on Thursday. So I sold half of the shares here on the 28th for a gain of 10.51%, and then the remaining shares on Thursday at 11.39%. But this is such a good example, everyone, of using an order block, having a very good risk to reward. I mean, look at the 50. I was 20 cents above that 50. The next day, had it closed below, I'd simply be out, right? I'm offering to get into a trade and saying, I'll lose a little based upon a key level with the potential to make a lot. Well, made a lot. So this is a very good example of risk to reward and what can happen if you are correct. I was risking very little, and I sold half here for a gain of 10.51%, and the remaining shares up 11.39%. So that was a really, really good trade. KMX. All right. This was a losing trade. I took KMX here on the 24th of October. Why? Well, this is a big wide order block. And I entered the trade here at 44.26 because the previous day we closed under the bottom of the order block. Here we closed back in the order block. That is called a rejection of the bottom of the order block. In addition to that, we had a nice V2. A V2 consists of 3 bars. Bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. That just added extra bonus points to the trade, right? We rejected the bottom of the order block plus a V2. Sounds pretty good. Gives me a good risk to reward ratio. Next day did go up, but then down and down. And I did have to exit here on the 29th. Why? Because it closed below the low of the order block, right? Losing trade, they happen all the time. You just try to keep them as low as possible. But this particular trade was a loss of 4.17%. Again, because it closed below the low of the order block. But that's it. You take the trade, you put the trade on. If it doesn't work, you get out. You don't cry about it. You just go on, right? Okay, Meta. Meta is a good learning example here, everyone. I took Meta back here on the 7th of October with a rejection of the high of the order block. I got in 713.07. I placed my emergency stop 2 ATRs below my end of bar stop. It erased my end of bar stop. Here's the halfway of the big up bar. Oh, let me move it up a little bit higher. Right about there. Okay, so I entered the trade because it rejected the high of the order block. Remember I was telling you about big up bars and having support at halfway? Okay, close below this 701 is my end of bar stop. So I entered position size, emergency stop, 2 ATRs below my end of bar stop, just to close below the 701 level, place my 1.5 ATR trailing stop level above. Next day up a little, next day up again, multiple profit targets, which was great. Next day down, but it held the halfway, it held that 701 level. Next day up a little bit, This day here tested my halfway mark, tested it and held like it often does, kept me in the trade. Next day up, profit target. Next day down a little, next day up a little, next day up, profit target, next day up again. Now I'm in trailing stop mode, okay? Now if I have a close below previous bar's low, I'm gonna get out of half. And then we just kind of drip higher, drip higher. Here we have a nice little kind of up move where I was able to sell into strength. And then I exited the trade here on the 29th. Why? Because earnings were after the bell. And I do not want to hold through earnings. And so I got out on the trade for a gain of 5.16%. Not bad. But more importantly, look what would have happened had I gambled and held through earnings. Would have turned into a massive loss, and that's why I suggest to my students not to hold through earnings. As a trader, your number one responsibility is to be a good steward and to not lose money. Don't put yourself in positions where you can have lose a lot of money quickly. Well, holding through earnings is exactly the perfect way to lose a lot of money quickly. Yes, of course you can make a lot of money quickly, but you're going to, if you're wrong, you can lose a lot of money quickly. We, as traders, we just don't want to put ourselves in that position. And the best way to do that is just get the heck out before earnings, like I did, right? And clearly that was the right reason. Later on in the podcast, I'm going to show you why I'm looking to buy Meta. But anyway, I exited the position, got out before earnings for a gain of 5.16%. FedEx, all right. FedEx is a short trade. I ended up getting out for a loss, but you know, I'm always showing you the green order blocks. Those are bullish areas. Well, there's such thing as a bearish order block as well, and it's exactly the opposite setup. Instead of starting with a swing low, then looking for a swing high and looking for a lower swing low, it's the opposite. You look for a swing high, followed by a lower swing low, followed by a higher swing high, and then taking out that first swing low changes the market structure. So when you change the market structure to the downside on a bearish one, the highest up bar close, the high and the low of that moving forward, is the bearish area. So I shorted FedEx here on the 21st of October for two reasons. One, it rejected the bottom of the order block. It went into the bearish order block above and closed below. That's showing me there were no more buyers up here, and that's the reason I entered the trade. I also entered the trade because we have this trend line here. If you connect the bottoms going up, that's a bullish trend line. But if you break the trend line to the downside, now that trend line above you is resistance if you get back to it. It's exactly what happened. So that is why I took the short trade. Rejection of the bottom in the order block, rejection of the once bullish trend line that is now a bearish trend line above. I got in 242.93 on the short. The next day, it did go down a little bit, enough for me to take a profit target, which ultimately was very fortunate. Next day, down again, so it started moving nicely my way, where I hit multiple profit targets on these 2 days down, but then went ripping right up. And my end of bar stop was simply a close above this trend line. The day before, it kept me in the trade because it closed below it. But then here on the day that I got out, it closed above it. I had to get out of the trade. So I had a loss on that trade of 2.53%, right? It was a good setup. I take the setup again. Just the great setups don't always have to work. And this one did not work. But from a teaching perspective, do you see why it was important that at least I took some of the position off at a profitable level, which mitigated when the market went against me, right? So again, a loss of 2.53% on this short trade. Okay, and so those are the four that I closed out. NVDA closed out half at 10.51%. closed out half at 11.39%. CarMax closed out for a loss of 4.17%. Meta closed out for a gain of 5.16%. And FedEx closed out for a loss on the short of 2.53%. Okay, so those are the daily opens and the close. Let's go to the weeklies. I also trade weekly bars. Weekly bars close on Friday. So I make my buying and selling decisions for weekly bars on Friday. Again, each bar here is a week. So I entered XLV all the way back here on 8/8/25. Why? Well, my favorite setup. You have a bullish order block from the past, and with inside that order block, you have a major moving average. I don't have to make my own line in the sand because I have the moving average. So the orange line is the 300-day moving average. And if you've been watching this channel for a while, for weeks, I talked about getting into XLV over here. I'm like, I want to get into XLV if and only if we come into the order block and reject the 300-day. Well, weeks went by, months went by, but finally here, it did what I wanted to do. It rejected the 300-day moving average and it closed above the order block. I got in 103.07. I placed my emergency stop, 2 ATRs below as always. My end of bar stop, simply a close below this 300-day moving average. Place my 1.5 ATR trailing stop level above, and next week, right out of the blocks, it went my way. Boom. Strong week up, hit multiple profit targets. Next week up again, took another profit target, got to trailing stop mode, right? Doesn't mean I do anything. It just means now in the future, if it closes below the previous bar's low, I get out of half. Move sideways, didn't do much. Here on this week, hit a profit target here. And then this week here on 9/26, we had our first close below a previous bar's low after reaching trailing stop level. I took off half of my position for a gain of 3.99%. Next week, up biggies, multiple profit targets for sure. Sold into that strength. Then we sold off a little bit. Not this week, but the week before, I hit another profit target. And currently, on this particular trade, the remaining shares that I have on this particular XLV weekly trade, up pretty nice, 9.82%. We're to 57.87 RSI. If we get into the 65 RSI level, now the 5 EMA will come into play as a stop, or as I showed you before in the video, if we reject the 70 and then have a close below a previous bar's low after rejecting the 70, then I'll be completely out of the trade. All right, but as is, the remaining shares up 9.82% on XLV. UUP, which is the dollar, nice trade on this, and again, pretty similar entry for me. Green order block, 200-week moving average. I entered here on 7/11/25 at 27.21 because two reasons. One, we rejected the high of the order block, and we had a close over the 200-week moving average. Two primary entry signals, entered 27.21, placed my emergency stop 2 ATRs below. As always, my end of bar stop, just simply a weekly close below this 200-week moving average, the black line. Place my trailing stop level above, off we go. Next week, up, little profit target, took one off, nice. Next week, came back down, retested the 200-week, closed above, kept me in. This week, next week, multiple profit targets, sold into that strength, also got to trailing stop level. Next week, nothing. Next week, first close below a previous bar's low after reaching trailing stop level. I took off half of the position for a gain of 0.51%. We moved sideways for about 5 weeks. This week here was below the 200, but it ultimately closed back above the 200, kept me in the trade. Next week up, profit targets. Next week kind of nothing burger. Next week up big, profit targets, right? Couple weeks sideways, and then this week up again nicely where I had hit additional profit targets. 60.42 is the RSI. Next week, if we get to 65 RSI, I will go into trailing stop mode. I'm sorry, I will go into 5 EMA mode with a close below the 5 EMA will get me completely out of the trade. So the remaining shares on UUP up 3.58%, which is a lot on a currency. So great trade there. TLT. I exited TLT on Friday. I've been in this trade since January. It's the last time I have to talk about it. I've been talking about this so long. Listen, everybody, I entered TLT back here on 117.25. Why? Rejection of the high of the order block and a V1. I got in 87.20. Placed my emergency stop, 2 ATRs below. My end bar stop, closed below the order block. 1.58 trailing stop level above. And off we go. Started off pretty good. Up, profit target, nothing. Multiple profit targets, got to trailing stop level. Moved sideways for about a month. Nothing. This week here, up big, profit targets. Remember, I'm in trailing stop mode. And the next week, sell off to the bottom. Well, clearly it closed below the previous bar's low after reaching trailing stop level. I had to get out of half of the shares for a loss, not a big one, but a loss of 0.58%. Remember, I have been selling into this trade all the way up, which is another, making another case of why it's important to sell into strength. But nonetheless, closed below a previous bar's low, took off half. Then for months, we went up a little. Every time it went up, I took some profits. We went down, but held my stop, and then finally here 9.5 we started to move up. Profit targets over the last month. Profit target. Finally, we closed below the 5 EMA. I exited all the remaining shares of the position for a gain of 3.42%. Now, TLT does pay a dividend, approximately 4%. It pays it monthly. So in addition to this trade of having the capital appreciation here, not a lot, but you can add about 4% onto this trade, not quite 4, maybe 3, because of the dividends that I had here. So that's the nice thing with trading, is that if you're in a dividend stock, not only are you making the capital appreciation on the underlying stock, but you're also making the dividend. If you're a little more advanced and you sell covered calls on top of that, like I do on a lot of different trades, then you have options premium, you have dividends, and capital appreciation. So it gives you a lot of options, literally options. But I'm glad to finally be out of this trade. I don't have to talk about it every week, but the remaining shares, I did exit because it closed below the 5 EMA for a gain of 3.42%. And then last but not least is Amazon. Okay, Amazon. I did short Amazon here on the 15th of August. Why? Well, you see the red box above. Red box means it is a bearish order block. Okay, we had a swing high, followed by a swing low, followed by a higher swing high, followed by market structure change to the downside. When it changed market structure to the downside, it defined the bearish order block of the highest up bar close before market structure change. Bring that into the future. No moving averages in this bearish order block, but as you know, I like to place my own levels in the order blocks, both bullish and bearish. Why? And so I did it here at 233.70. Why? Well, look at the bar here. Remember how I told you if you have a big up bar, if you come back to halfway, you'll have support? Again, it works the opposite. If you have a big down bar and then you come to halfway of that, that's going to be resistance. So that is the reason for the trade. I entered here on the 15th of August. One, because we're in a bearish order block, and two, it rejected my down halfway bar at 233.70. So I entered the short position here. I placed my I placed my emergency stop 2 ATRs above because it's a short. My end of bar stop is simply a close above this 233.70 level. So I have a good risk to reward ratio. I placed my 1.5 ATR trailing stop level below. And then for about 5 weeks, we really didn't do anything. But do you see how we went above my end of bar stop and closed below it, kept me in? Went above my end of bar stop, closed below, kept me in it. Above, closed below, kept me in it. And then we had about a month to the downside where it did start going my way, where I hit some profit targets here. I hit some profit targets here. So I exited the position this week at 233.01 and locked in a gain, not a huge gain, but a pretty decent gain at 370. So why did I get out here? Because of earnings. Look, I got out here the day before earnings. Earnings was it yesterday? Yeah, I guess it was yesterday. So Thursday, no, it's Thursday, right? Yeah, Thursday after the bell. Yeah, so I got out before the earnings. Had I not gotten out with my short position, I would have got hammered, right? Because it was up 9.58%. So again, 2 examples today on Meta and Amazon, both long and short. I was long and short, but I did not hold through earnings. Had I held through earnings, I would have got smashed on both of them. Okay. But grateful for this trade. It wasn't a huge trade. I was in it for a while, but it was a gain of 3.47% gain on the short side. So just a recap of the weeklies now, and then we can move on to something else. XLV remaining shares up 9.82%. UUP remaining shares up 3.58%. TLT, I exited the position for a gain of wait, did I do that right? Oh, they're close, yeah. So UUP up 3.58%. TLT exited the trade 3.42%. XLV remaining shares up 9.82%. And Amazon, the short, exited because of earnings with a gain of 3.7%. Okay, so I hope that was helpful, everyone, just to see all the positions, how I managed them. There were winners, there were losers. But ultimately, at the end of the week with my trading, I am trying to have as big as winning trades as possible. But what I'm really trying to do is not to have big losses. And yes, I had a few losses here, a few losses. But all in all, some of the gains I had were really big. Some of the gains I had were medium. Some I had were small. Some of the losses I had were small. But I didn't have any big losses. So I did my job, right? Big gains acceptable, small gains acceptable, break even trades acceptable, small losses acceptable. But if you have big losses, then the math is not going to add up for you in trading. All right. Okay, let's talk a little bit about trading psychology. This is from Peter Robbins. Peter Robbins is a very famous trader. He was featured in Unknown Market Wizards, which is a great book to read, Jack Schwager's book. And I learned about Peter Robbins by reading that book. And I follow him. You can follow him at PR Robbins over on Twitter, over on X. And so whenever Peter writes something, the guy knows what he's talking about. And so when he says something, I'm going to read it and take it in. So Peter says the best traders aren't right more often. They just lose less when they're wrong. Ah, interesting. The best traders aren't right more often. They just lose less when they're wrong. A high win rate is great, but not what determines your final results. So a lot of beginner traders just think that really good traders are just right all the time. Well, like Peter says, they're not. They just know how to lose better. Their losses are just smaller. See, the problem with beginning traders, retail traders, is that they're very impatient with their winners. They want to get out quickly, feels good. But they're very patient with their losers, which is the most horrible thing. And you need to be the opposite. You need to be very impatient with your losers, and you need to be very patient with your winners. That's what I'm saying. Get yourself a process that keeps you in a winning trade, but gets you out quickly. It's just like all the trades that I just showed you. I was in some of those for months. But when I have a losing trade, very often I'm out in 1 day, 2 days, 3 days, right? So I'm very impatient with my losers, and I'm very patient and have a process with my winners. And win rate, a lot of people talk about win rate. Oh man, this has an 88% win rate. All that means is that yes, it has a win rate of 88%, but your wins are really small. And the other and then when you have a loss, the losses are going to be large. So anytime somebody says, "Oh man, I have 90% win rate on this," and I already know, okay, 90% of the times you make a little, and 10% of the time you lose a lot, right? Some of the best traders in the world have a win rate of 25, 30%. They only win 20 or 25 to 30% of the time, but they're losing. They have a high losing rate, small, but the ones that they win huge, right? So don't get enamored with win rates. It's about profit factors. So again, one more time from Peter Robbins. The best traders aren't right more often. They just lose less when they're wrong. A high win rate is great, but not what determines your final results. Okay? Your final results is a combination of your win rate and your profit factor. So anyway, thank you, Peter. That's a great post. It's a great reminder. Again, please try to follow Peter over at PR Robbins over on X. And thanks for the great post, Peter. So, all right, let's get to my potential trades for next week, shall we? Okay, so here on the dailies, I don't have any on the weeklies, but here on the dailies, I have 11 different potential setups for next week. Now, as always, it is potential. I mean, it is theoretically possible that next week all of these could trigger. They could even trigger on the same day. Does that mean I'm going to take all 11 trades on the same day? No, never. Never. I only take one trade per day. Even if I have 10 candidates that are legit, I'm going to narrow those 10 candidates down to one. How do I do that? Well, I have a scoring method where I give a trade. Just in simplistic terms, if it has one entry signal, I give it a score of 1. If another one has has 2 entry signals, it gets a score of 2. Which one do you think I'm going to take? I'm going to take the one that has the highest score. Then I also have, so in addition to factoring in entry signals, I also have to factor in risk to reward. Maybe I have one that has 3 entry signals, but the risk to reward's not good anymore. Well, I have to take that into consideration. I also look at higher time frames. Do I have support levels, other things going on a higher time frame? I look at the relative strength. Market's down, but this market's up. Okay, it gets a bonus point, right? So this is how I do it. So I have 11 here. I'm going to show you 11. But if they all trigger on the same day, I'm only going to take one, right? And this is how I trade. This is what I teach my students. Oh, and by the way, I teach students all over the world. I have been teaching for years and years. I have taught students all the way from absolute beginners all the way up to the hedge fund level. And I teach a 20-hour course. It's a one-on-one course. I think the best way to learn anything is one-on-one with a professional instructor that knows what they're doing. And so I have taught so many good traders and created so many good traders around the world. And if you're interested in doing this course with me, I do it. It's 2 hours a week for 10 weeks. I teach you all of my setups. I teach you all of my processes. We do all sorts of simulation trading. And let me just tell you, when you're done, you are going to be a better trader. It is absolutely a really good course. It's an investment in yourself. But talk to some of my traders. I talk to some of my traders on a weekly basis, and I see what they're doing. It's really good. It's really great. So if you'd like to be a student of mine, my email is in the link of this YouTube video. Just reach out to me. Usually I just like to have an initial, it's a free Zoom call, and just learn more about that student, what their goals are, what their challenges are. It's a good time for them to ask me questions about the course. And it's not a sales call, I promise you. It's just to get to know each other call and see if we're a good fit. But if you want to get serious about trading and you want to learn to trade like I do, I'd love to have you as my student. And then last little plug as well, you've heard me talk about deep dip buy. If you're not able to do the one-on-one course with me, I have a really good online course available at udemy.com where I teach you the deep dip buy strategy. It's 9.5 hours of video. It's a great course. I've sold so many around the world and I have like a 4.9 stars on it. And I think you would enjoy that. So the link's in the description as well. Okay, so end of the plugs, everybody. Just had to do a little business there. But let's get into next week and see what we have. All right, Southwest Airlines is first up, first on deck. All right, Southwest had a nice trade on Southwest. If you remember back in this region over here, sold here before earnings. It was a nice trade. But at the moment, take a look. We have an order block you can see down here. Why order block? Swing low, swing high, ran liquidity to the downside, change market structure, change here. As soon as we change market structure, we define the high and the low, the lowest closing bar prior to market structure change, and bring it into the future. Okay, that market structure change really did work because look, we went up, and again, when you're up here in hindsight, was smart money buying down here? Yeah. When we're up here, look back to the order block. Was smart money buying down here? Yes. So the thinking is if you come back down into the previous smart money area, it might be smart money area again. It may be, it may not. More times than not it is, but not all the time. So here we have an order block. It's a fairly wide, high order block. So I don't have a major moving average living inside this order block, but I do have this V2, bar 1, bar 2, bar 3. 2 goes under bar 1's low, 3 closes above bar 1's close. Okay, V1s, V2s are bullish, and you can see that was. But when you have a V2, the washout bar, the second bar, halfway of that bar is going to be some support. That is why I identified this level and brought it into the future. So what I'm looking for next week on love would be potentially a rejection of this half midpoint inside the bullish order block at 29.24. If it loses that and rejects the bottom of the order block, I could also consider that one as well. The reason I like this halfway point of that V2 at 29.94 is it dovetails with the negative third ATR channel. This is thick line right here. You know, third ATR channels, positive and negative, tend to be support levels. You can see when we got the third ATR channel, ran out of gas. If you get to the negative third ATR channel, doesn't mean it has to bounce there. It has a propensity to do that, but taking everything into account, negative third ATR channel, midpoint of the V2, and the bullish order block, you know, it's probably a pretty high probability trade. But high probability trades lose too. So therefore, we need to position size correctly. We need to have our end of day stops. We need to have our emergency stops, all this stuff, right? So I don't know if Southwest is going to get there. If it does and does exactly what I want us to do, yes, then I'll consider taking the trade. It would be a high probability trade with a good risk to reward ratio. But as always, if it closes 1 penny below my stop, boom, I'm out. I don't cry about it. I move on. I wait for another one. So that's what I'm looking for. Essentially, I'm looking for a rejection of 29.24 next week. MasterCard, MA. Okay, it's very similar to Love. We have an order block that was created all the way back here on 6/20/25. It was a V2, bar 1, bar 2. Bar 2 goes below bar 1's low. Bar 3 goes above bar 1's close. Middle of that bar is the support level 531 even. Okay, well, the V2 started a nice big move up. Define the order block. Well, after months and months and months, we are now back into potentially getting back to the order block. This is a wide order block. I would not take it with just a rejection of the high of the order block. What I'm looking for, a few things here, actually. The main thing is I'm looking for a rejection of 531, halfway of the V2 to the left, okay? Rejection of 531. That is one potential entry. Second potential entry would be a rejection of the low of the order block. A third potential rejection would be the RSI. If we go under the 30 RSI and then close back above the 30 RSI, whether that's intraday or day to day, that is a deep dip buy signal, legitimate by itself, but better because we're in the bullish order block. All right, so a rejection of 531 would be one potential, and under 30 over 30 on the RSI would be a second potential. Rejection at the bottom of the order block would be the third potential on MasterCard. All right, Meta had the nice trade on Meta. Fortunately, got out before earnings because I do not hold through earnings. So Meta's really got hammered here, right? We've lost a lot of things, trend lines, we've lost all sorts of things. Really, the next stop for me on Meta goes all the way back to the order block on 523.25. You can see it's a teeny weeny little order block here. In addition to the order block, we have a V2. Bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low, bar 3 closes above bar 1's close. Okay, where's the support going to be on that? Halfway of the washout bar. That's 626. So it's an order block as well. We move the order block into the future. We have the halfway point of the V2 there. So now this order block is not very tall. It's pretty narrow. So next week, if we reject the high of the order block, just the high of the order block, 633.02, I would take that too, because where's my stop going to be on this? Close below the low of the order block, okay? But if it doesn't reject the high of the order block, but rejects the 626 level in the middle, sure, take that. And the low of the order block is about 622.08, certainly. So this order block, if it rejects this order block, very likely I will consider taking the trade because regardless of where it rejects, it's a decent risk to reward ratio. Now, it may not get there, all right? It may get $5 from there and then head all the way back up and, oh, Greg, you missed the trade. Yeah, missed the trade. Happens all the time. Fine with it. There's plenty of trades that will get to where I want it to get, right? So just kind of in general, Meta, I'm kind of looking for some kind of rejection of 632 down to 622. Clearly oversold technically and coming into a long-term potential, right? Could be a really good long-term trade. Altria, MO. Well, MO got whacked up, didn't it, on earnings? My goodness me. Well, listen, we're in an order block right now. And technically, I could have taken this trade because it looks like it rejected the bottom of the order block. Well, maybe not. I think it closed right below it, so disregard what I just said. I would not have taken the trade anyway. Why? Because it looks like we had earnings. We had a big, huge sell-off here. When you have these big skyscraper bars down, I don't want to be in a big rush to try to get long after this huge, big move. I'd rather see it, have the big sell-off, have some consolidation, wait for an equal amount of buyers and sellers. But really what I'm looking for on MO, and I'm not dying to get into MO, but if it gets here, okay. Look, there's an order block all the way here on 514.25. Again, we have a V2. We have that midline at 54.50. It's a narrow order block. Move it all the way into the future. This at one point was really smart money. When you look up here all the way back, was that smart money? Certainly was. Well, we're kind of coming into that smart money area again. So what I'm looking for here is a rejection of any part of the order block, 54.87 all the way down to 54.24, somewhere in the 54s is kind of what I'm looking for. It's only a couple dollars below. So that could be a really nice long-term bounce area, or maybe it goes right through and it's a loss. I don't know. But again, I like to buy stuff on sale, but I like to buy stuff on sale where I know exactly what I'm going to do, right? Not just buying it because it's low. I'm buying it or potentially buying it because it's possibly coming into this order block. Microsoft, all right, Microsoft has some bad relative strength. I was talking about relative strength earlier. Market was up on Friday, Microsoft was down. That's a negative. So I have this wide order block here on Microsoft from 511.97 down to 492.37. Okay. Inside of this order block, we have the red line. That's a 100-day moving average. Listen, in the future, if we reject that 100-day, and that 100-day is at right now 508.96, if we reject it, close back above it, sure, I consider taking the trade on Microsoft. Just because it rejected the 100? No. But because it rejected the 100 inside the bullish order block. That's why. So that one's pretty simple. Netflix. All right. So Netflix had a nice day up on Friday, mainly on news. They're going to do 10-to-1 split. But look, we are inside an order block, and technically we did close the previous day. We closed below the order block and then closed back in the order block. Is that a legitimate signal? Yes, technically it is. And one of my friends and one of my students, Steve, we were discussing this on Friday. He goes, "Are you looking to enter Netflix?" No, like it's legit for sure. It's legit. But on Friday, we created an abandoned baby. Do you remember these? What's an abandoned baby? It happened on Thursday. Well, it happened on Friday, but on Wednesday, we gapped down. So the sentiment from the open to the close was negative. Friday, we gap up. So we had a very quick shift in sentiment. Gap down, gap up. That creates an abandoned baby. I highlighted it here in blue. The most important level on abandoned baby is the high of the abandoned baby, which right now is here at about 1106.60. So yes, this is legitimate. We close under the order block, we close above the order block. That's to the bright side, the positive side. The negative side is we rejected the 200-day moving average above us, okay? That's a little, so far there weren't any buyers up there. So what I'd like to see Netflix do is come back down, retest the bottom of the order block, at the very least, retest the high of the baby at 111.06. And it very well could do that. And if it does, and then gives me a better risk to reward ratio, I'll take that. But yes, technically, this is a legitimate order on Friday. I did not take it. I'm just waiting for a little better, just call it, I'm looking for a rejection of the order block one more time, just to test 1103.44. But yes, Steve, you are right. It was legitimate, but I'm just explaining that is why it rejected the 200-day above. I didn't like that. And the risk to reward ratio is not so great. But so I'm looking for basically a rejection of 1106.16. And if it does, I'll consider taking that. Nike, NKE. All right, look, Nike, I really don't expect Nike to get here, but if it does, okay. So look, I've talked to you about megaphone trend lines. Take a swing low, you take a lower swing low, and you draw that trend line out into the future like a megaphone. Okay, many times when you do this, if in the future you do come down to that extension point of that trend line, very often it bounces there, right? So I'm seeing two things here. One, extension of this megaphone trend line. Look, it dovetails perfectly with a previous order block. This order block happened all the way back here on the 18th of June. Okay, that's the level, man. That's what I'm looking for. Will it get there? I have no idea. Probably not. But if it does, I want to have it marked out and ready for it so that it's easy to make a decision. So this order block here is 60.19 to 58.88. So next week, if Nike does reject the high of this order block, 60.26, or the lower of the order block, 59, or test that trend line within it, yeah. I mean, clearly, Nike is just, it's extremely oversold, but oversold things can keep going down. But, this is one of the things. If it wants to give me a Christmas gift at this low level, sure, I'll take it, but only if it gets there. Philip Morris, PM. Okay, well, Philip Morris, all these consumer kind of stocks, of course, are just getting pounded to the downside, right? Tech stocks going up, but your Philip Morris's, your Nikes, Altria's not doing so well. But PM. Now, PM has an order block from the past. It also has the megaphone trend line that I was talking about. Connect the bottom here, here, and here. Well, that's a good example. My friend Vivek, student Vivek from Canada, pointed this out. Look where it bounced. Yeah, it did bounce and close back over that trend line, that megaphone trend line. But to me, to my eye, it did not close above the low of the order block. So if on Monday we close back in the order block, yeah, I'll consider taking the trade for sure, because we have already rejected the megaphone trend line here. And if it closes in the green, if it closes up here, maybe not. But if it has a nice close in here, then that just sets me up for a good risk to reward ratio. So I will consider getting into Philip Morris, but it has to close, just call it 144.45, something like that. It's only 10, 11 cents higher than this. All right, TMUS, which is T-Mobile. Ugly. Ugly, 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 this chart. Boy, everybody had to have it up here. Nobody wants it down here when it's on sale. Well, we are in a bullish order block. Has it rejected the higher of the order block? No. Has it rejected the low of the order block? No. Here's a megaphone trend line. This one's pretty easy. If we reject that trend line, or in other words, if we can close back above the high of that order block, 212.92, it's rejection of the high of the order block. That would be one potential entry. If we go lower, if we need to reject the bottom of the order block is like 205.51. So I'm not super excited to get into T-Mobile, but it is getting into an interesting area. So either basically a close above the high of the order block, 212.62, rejection of the bottom of the order block, 205.66, might get interested and take a trade there. United Airlines. Okay, this one's pretty easy. Of course, the airlines have come all the way back down. We have a nice order block here on the 1st of August, and we rallied. When we were way up here at the highs, could you look back at that order block and say that was smart money? Sure. Absolutely, without a doubt. When you're up here, smart money was buying there. Well, bring that smart money area into the future. Are we there now? Yeah, not yet, but we're getting close. And inside that smart money area is deep dip by 300-day moving average, the orange line. So again, I don't have to get into United Airlines, but if it does come exactly into this order block here and reject that 300-day moving average at 84.55, I would consider it. It looks very much like my XLV trade. But the key with that XLV trade was being patient and waiting for him. So United Airlines, maybe it gets there, but maybe it's 2 weeks from now, 3 weeks from now, who knows? But that's what I'm looking for. Rejection of the high of the order block, a rejection of the 300-day moving average in the middle, 84.55, or rejection of the low of the order block, which is 83.20. Last one, everyone, yay! XLF. I've talked about this one for a while. I said if it gets there, it gets there. Order block all the way back here, 8.1. Bring the order block into the future. Inside the order block, we have a 200-day moving average. That is an order block deep dip by potential setup. So next week, if and only if we reject the 200-day moving average, we bounce, intraday rejection, close under, close over the 51.26 level. Yeah, it's good risk to reward ratio, high probability setup. Does it mean it's going to work? No, but it has a better chance than not. And that's all we can really ask for. Right. So next week, if we reject 51.26 on XLF in this order block, I will consider taking the trade. All right, everybody. I hope this was helpful. If you have any questions, please put them in the comment section. I'll do my best to get back to you. If you found it helpful today, appreciate if you hit the thumbs up button. Love to have you as my student. All you have to do is send me an email. We can talk about moving forward. I'll teach you everything I know. I promise you'll be really glad that you took the course. I've been teaching so much this year, but I really, really enjoy it. And I think you'll enjoy what you're going to be taught too. So I hope you have a good rest of your weekend. God willing, I will see you next week. Please try to go out and do something nice for somebody each day if you have the opportunity. It would make the world a better place. If you can also, if you have the opportunity, do one nice thing for an animal each day. They appreciate acts of kindness just like we do, right? Just good karma, all comes back around. But enjoy your weekend, rest up, be careful next week. Get yourself a process, right? Follow that process. And again, I appreciate you being here. Thanks a lot, everybody. Have a good rest of your weekend. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and Forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.